If you've ever looked at your paycheck, your real paycheck, after everything gets taken out and felt a quiet, simmering frustration that nobody talks about openly, this video is for you. Watch until the end to get free resources to start your investment journey right now. Here's something most high-income professionals have in common. They work harder than almost anyone they know. They spend a decade or more training in their careers, and they earn more than 95% of the country. And yet, every single year, they hand over an enormous portion of everything they've earned to the IRS. And they do it without fully understanding why, or whether it has to be that way. I'm going to tell you something that might sting a little. The tax code is not designed to punish you for earning a high income. It's actually full of legal, legitimate strategies that can dramatically reduce what you owe. Strategies that wealthy real estate investors and business owners use every single year. But here's the problem. No one taught you about any of that. Not in medical school, not in your MBA program, not in your residency, and almost certainly not from your CPA, who, in many cases, is focused on filing your return correctly, not on proactively building you a tax strategy. Today, I'm going to change that. I'm going to show you exactly why physicians and executives pay so much in taxes, why most of them are completely blind at tax-efficient investing, and what the smartest high-income investors are actually doing legally to keep more of what they earn. Let's get into it. First, let me be clear about who this video is for. This is for the physician earning $200,000, $300,000, $500,000 or more. The executive with a W-2 income and a substantial bonus. The specialist, the partner track attorney, the senior engineer. Anyone who works incredibly hard, earns well, and still feels like they're running in place financially. You don't need to already be a real estate investor to get value from this. You just need to be willing to understand how the tax code actually works and how it's being used against you right now. Now, let me bust two myths that keep smart, high-earning people trapped. Myth number one, my CPA handles my taxes, so I'm probably fine. I say this with respect. Most CPAs are excellent at what they do, but there's a critical difference between tax compliance and tax strategy. Compliance means filing your return accurately. Strategy means proactively reducing how much you owe before the return is ever filed. Most high-income professionals are getting compliance. They're not getting strategy. And that gap is costing them tens of thousands of dollars every single year. Myth number two, tax-efficient investing is for the ultra-wealthy or for people who take big risks. This is completely false. The tax advantages I'm going to walk you through today are written directly into IRS code. They're not loopholes. They're not aggressive shelters. They are intentional provisions that Congress put in place to incentivize investment in real estate and housing. The ultra-wealthy use them because they know about them. Most physicians and executives don't use them because nobody told them they exist, and that changes today. Let me start with the core problem, the mechanism that explains why high earners pay so much tax. It comes down to one word: ordinary income. When you earn a paycheck, whether you're a W-2 employee or a 1099 independent contractor, every dollar you earn is classified as ordinary income by the IRS. And ordinary income is taxed at the highest possible rates. Here's what that looks like, at least in the past 2025. According to the IRS, the top federal marginal tax rate is 37%. That kicks in at $626,000 for a single filer and $751,600 for married couples filing jointly. But most attending physicians and senior executives hit the 35% bracket well before those thresholds. That bracket starts at $250,500 or so for single filers and $501,000 for married couples. Add your state income tax, which in high tax states like California, New York, New Jersey, that can be another 9 to 13% on top of that. and you are looking at a combined marginal rate of 45 to 50% on every additional dollar you earn. Think about that for a moment. For every $2 you earn above a certain threshold, you're sending one of them to the government. Now, here's what makes this even more frustrating. The tax code treats different types of income very differently. Long-term capital gains, income that from selling an asset you've held for more than a year or so, are taxed at a maximum rate of 20%. Qualified dividends, same thing. Passive real estate income sheltered by depreciation, that could be taxed at effectively zero. But ordinary W-2 income, 37% federal plus state. The wealthy don't earn most of their money as ordinary income. They earn it as capital gains, passive income, and depreciation sheltered cash flow. That's the real secret. And it's not a secret at all. It's right there in the tax code. What do you do about it? Here's the step-by-step framework. Step 1 is understanding depreciation. This is the single most powerful tax tool available to real estate investors. And most physicians and executives have never heard of it, or definitely not used this way. Here's how it works. The IRS allows you to deduct the cost of a rental property over its useful life, 27.5 years for residential real estate. According to IRS publication 527, what that means in practice is that every year you can deduct a portion of the property's value as a paper loss, even if the property is generating positive cash flow. Now, let's make that concrete. For ease of math, on a $1 million residential property, setting aside the land value, your annual straight line depreciation deduction is roughly $36,000 per year. That $36,000 reduces your taxable passive income dollar for dollar. Step 2 is understanding cost segregation. And this is where it gets really powerful. Cost segregation is a tax strategy that accelerates your depreciation deductions. Instead of deducting your property over 27.5 years, a cost segregation study conducted by firms like KBKG breaks the property into components: flooring, cabinetry, appliances, lighting, landscaping. These components have a shorter depreciation schedules, 5, 7, and 15 years instead of 27.5. Now, what that means is that instead of spreading your deductions over nearly 3 decades, you can front load a massive portion of them into the first year or 2 of ownership. And here's a real example from KBKG published from their case studies. On a medical office building purchased for $3.58 million, a cost segregation study generated over $1 million in additional first-year tax deductions. At a combined federal and state tax rate of around 35%, that's $350,000 in tax savings in a single year. And here's the 2025 update that makes this even more compelling. The One Big Beautiful Bill Act, signed into law in 2025, permanently restored 100% bonus depreciation for qualified property placed in service after January 19th of 2025. That means eligible assets identified through a cost segregation study can potentially be fully expensed in year 1. And step 3 is understanding the passive activity rules and their exceptions. And here's where most high earners hit a wall. Under IRS publication 925, the passive activity and at-risk rules, rental real estate losses are generally classified as passive, and passive losses can only offset passive income, not your W-2 salary. So if you're a physician earning $500,000 in clinical income and you have $80,000 in paper depreciation losses from real estate, under the standard rules, you can't use those losses to reduce your W-2 income. But there are 2 important exceptions, and this is step 3, knowing which one applies to you. The first is real estate professional status, or REPS. If you or your spouse spend more than 750 hours per year working in real estate and more time in real estate than in any other profession, the IRS reclassifies your rental losses as non-passive. That means those depreciation deductions can directly offset your clinical or executive income. This is difficult for a full-time physician to achieve personally, but it's often achievable for a spouse who actively manages properties or works in the real estate business. The second exception is the short-term rental strategy. If you own a rental property where the average guest stay is 7 days or less, important, think short-term vacation rentals, and you materially participate in managing it, the IRS does not classify it as rental activity under the passive activity rules. That means the losses, including accelerated depreciation from a cost segregation study, can certainly offset your active income, even without reps. So according to the white coat investor community, this has been one of the most accessible tax strategies for busy physicians who want to reduce their tax burden without becoming full-time real estate operators. Step 4 is strategic asset location. This is about where you hold your investments, not just what you hold. Tax efficient assets like equity real estate, where income can be sheltered by depreciation, belongs in your taxable accounts. Tax inefficient assets like bonds, REITs, and actively managed funds that generate ordinary income belong in your tax protected accounts like your 401k or like an IRA. Most high earners have this backwards. They hold their most tax inefficient investments in their taxable brokerage accounts and wonder why they keep getting hit with a large tax bill every spring. Step 5 is building a proactive tax team. This is critical, and it's the step most people skip. Before you can do any of this effectively, you need a CPA who specializes in high-income professionals and real estate investors, not a generalist, a specialist, someone who proactively looks for opportunities before you file, not after. And step 5 is what makes steps 1 through 4 actually work in practice. Without the right advisor in your corner, best strategies in the world stay theoretical. Let me make this tangible with a real scenario. Imagine a physician earning $450,000 in W-2 income at the 35% federal tax bracket plus a 9% state tax. Their combined marginal rate is 44%. On every dollar they earn above the threshold, they keep 56 cents. Now, imagine that same physician purchases a short-term rental property for $750,000. They commission a cost segregation study. The study identifies $234,000 in first-year accelerated deductions, a real number from KBKG's published case studies on similar properties. With 100% bonus appreciation restored in 2025, that $234,000 in deductions can potentially be taken in year 1 at a 44% combined marginal rate, and that's over $100,000 in tax savings in a single year. That's not theoretical. That's the tax code working exactly as it was designed to work. Now, let me address the objections. This sounds complicated. I don't have time for this. The strategy itself is not something you execute personally. You hire the right CPA. You commission a cost segregation study from a firm like KBKG, and you work with a tax advisor who understands real estate. Your job is to understand the framework well enough to ask the right questions. You don't need to become a tax expert. You need to know enough to know what you're missing. What if I get audited? Cost segregation studies conducted by qualified engineering firms are specifically designed to withstand IRS review. KBKG explicitly states that their studies provide independent third-party analysis built to hold up under scrutiny. These are not aggressive positions. They are well-documented engineering-based analysis of property components. I don't want to be a landlord. You don't have to be. The short-term rental strategy does require some active involvement in management, but passive real estate investing through syndications where you invest alongside professional operators can still generate tax-sheltered passive income that offsets other passive income streams. And as your portfolio grows, the passive losses can carry forward and eventually be released when you sell a property in a fully taxable transaction. Now, here's the vision I want to leave you with. Imagine it's 3 years from now. You've built a proactive tax strategy. You've made 1 or 2 real estate investments structured correctly with the right advisors in place. You've taken advantage of cost segregation and bonus depreciation. And at the end of the year, instead of writing a check to the IRS for $150,000 or $200,000, you've legally, legitimately reduced that sum considerably by a number, by 80,000 to 100,000. That money didn't disappear. It went into your next investment, which generated more passive income, which was sheltered by more depreciation, and the cycle compounds. That is how the wealthy build wealth, not by earning more, but by keeping more of what they've already earned. And the most important realization, the tax code was written to help you do exactly that. You just have to know where to look. If you are serious about keeping more of what you earn, building passive income that grows quietly in the background, and creating a financial foundation that outlasts your career, the single best step you can take right now is to go and grab those free resources. I've put together 2 free ebooks that you can download right now. They're written specifically for high-income professionals and walk you through the foundational concepts of real estate and passive real estate investing and tax-efficient wealth building in plain, clear language. Head over to www.cardia. I'll see you in the next video.